Today I will present you a new webinar about trading basics. So you will, if you already don't know it, you will learn and I will teach you what basically Pips is, what leverage is, what margin call is, and what other trading basic stuff are. So let's start with a small risk disclaimer, but you already know it, and by accepting the risk disclaimer, you are going with me further. So let's start and don't waste our time. Today agenda is trading sessions, Pip and Spread, lots, leverage, margin call, profit and loss, and types of orders. So today we will have this agenda. I was also thinking about some Forex glossary, but I think that it will be, I will leave it for a next webinar maybe. So Forex glossary, and so you will know what Forex pros, what they use for abbreviations, and what news abbreviations are also. So we will talk about it a little bit later. So let's start with trading sessions. As you already know, I like and I prefer to trade a London session. But prior to London, we have Frankfurt session. So there is Frankfurt session, London, New York, Sydney, and Tokyo. Those are five sessions that are linked together. And because of that, Forex market works 24 hours per day. If you don't know it already, Forex market also works on weekends, but traders don't trade on weekends because interbank market works. But we retail traders and most of hedge fund and institutional traders don't work for weekends because they don't want to risk their positions. As you already know, there were many times when price just spiked up or synced down on the weekends. So basically we are working till Monday to Friday. So I have given you an example of trading session and time zones. So these are times, Central European times, and now it's GMT +1. So basically if you are using the same time as me, now it's 6:10 p.m. So these are the times when sessions are open. These are, I mind you, these are correct times. There are some Forex sites that do not show a clear price, clear time zones, and you can be a little bit confused. But these are now correct time zones because we are in GMT +2 and London is GMT +1 currently. So you need to use this table to know what basically when to trade and when not to trade. So Frankfurt starts at 8 a.m. and closes at 4 p.m. London starts at 9 a.m. and closes at 5 p.m. So you already know that there is a cross session. Cross session starts when New York starts. This is exactly 2 p.m. and ends on 10 p.m. So basically we are trading, the most volatile session is from 2 p.m. to 5 p.m. Usually around 5:30 p.m. London closes completely. So we can see some price volatility even after London around 7 or 8 p.m. during New York session. So New York session is most volatile when it starts, and 6 hours after it, 5 or 6 hours, it's 7 or 8 p.m. Lately it was around 7 or 8 p.m. Sydney is 12 a.m. It's just at midnight and till 8 a.m. Sydney start is non-volatile, so I never recommend trading on Sydney session because we need to wait for Tokyo. Tokyo opens up just 1 hour after Sydney opens, and it's around 1 a.m. and it lasts till 9 a.m. So when London starts, Tokyo closes. Tokyo session is most volatile around 2:30 a.m. and it can be even volatile around 5 or 6 a.m. just prior to Frankfurt open. My favorite trading hours and I recommend it also for you, are the first 3 hours of each session. It's then when we try to position ourselves, or eventually we take some scalp trades. So basically those are first 3 hours of each session. So first 3 hours of London and first 3 hours of New York. And of course first 3 hours of Tokyo session if you are close to that time zone. But for us here in Europe it's a little bit late, so I guess most of us don't trade Tokyo session. It would be really too much to trade London and Tokyo. Well, we need to sleep. So is this all Germany time? Oh, okay. I will answer these questions later. No problem. If you want to ask questions, no problem. You can type it. I will ask it a little bit later. So London is the most volatile session, and London New York cross session, and Sydney to Tokyo session is the least volatile. So I can give you a quick answer. Yes, it's basically a Germany time, so it's GMT +1, and this is London Standard Time, because London is now GMT +1, and we here in Serbia are GMT +2. So basically we are all using London time for reference. So you can use this table, it's correct. 9 a.m. till 5 p.m. for London. So if you live in Sydney, I advise you to trade Tokyo. Don't try to open positions around midnight. There can be really slow volatility, and it's very hard to make money, you know, when volatility is low. So if this is clear, we can move on to our next slide. And our next slide is basically we will talk about Pip and Spread. So most of you probably know, but I will try to explain you know, as clear as possible. So what is a pip? Many of you know it if you already trade, or if you demo trade it, you know what pip is. Pip is a percentage in point, and that is the smallest price increment in Forex trading. So this is the definition, the smallest price increment in Forex trading. And prices today, and we are talking about today's market, prices are quoted to the 5th decimal point in the Forex market. In this example, you can see a bid and ask price. Euro USD might be bid at 1.30267 and offered at 1.30272. So difference between bid and ask is called spread. And in this example, the spread is 0.5 pips. So this is clear, probably. The only exception is the Japanese yen, because it's quoted only to the 3rd decimal point. A couple of years ago, most Forex currency pairs were quoted to the 4th decimal point. But due to expansion of Forex market, due to ECN brokerage, now today we have a 5th decimal. And in the case of Japanese yen, we have the 3rd decimal point. Now, we are talking about Euro USD, right? The first listed currency to the left is, if we have a slash, or if we don't have a slash, in this example it's Euro. It's called base currency. To the right, the second one is called counter or quote currency. It's US dollar. The base currency is the basis for the buy or the sell. So if you buy Euro USD, that simply means that you are buying the base currency and at the same time selling the quote currency. So we say that buy euro, sell dollar. So buy euro, sell USD. So you would buy the pair if you believe the base currency will appreciate, gain in value, in relative, of course, to the quote currency. And vice versa, sorry, I need to, my Skype set to don't disturb. Okay, thank you. So this is for buy. If we want to sell, then basically we are selling the base currency and buying the quote currency. So that is how we make or lose profits in Forex market. If we buy it, we are calling it going long, and if we sell it, we are calling it going short. So going long is basically a buy position, or taking a short position, it's called going short. I think that this, well, most of you know that already, but for novice traders, we simply, we are talking that way. So basically long and short is the way we traders talk. So Pip is a percentage point, is the smallest price increment in Forex market, and the spread is difference between bid and ask price or between sell and buy price. If it's for you, it's clear, maybe it's more clear to say buy or sell. So sell is called bid and buy is called offer. And the spread is difference between those two things. Now we need to talk a little bit about lots and leverage. So this basically is the thing from the past. As in the past, spot Forex was traded in specific amounts called lots. Standard lot size for a lot is 100,000 units. There is also mini, micro, nano lot sizes. They're just respectively, I will talk 10,000, 1,000 and 100 units. So, as you already know, change in currency value relative to another is measured in pips. To take advantage of that change, small increment, we need to trade large amounts of a particular currency in order to see any significant profit or a loss. Translated to MetaTrader 4, a standard lot is one lot. That's one lot standard. One standard MetaTrader lot is worth of 100,000 units of, let's say, US dollars. 10,000 US dollars is 0.1 on MetaTrader 4, or it's called mini. Micro is 0.01 and nano is 0.001. So there is number of units and respectively MetaTrader 4 lot size. In order to be competitive, in order to trade on ECN, we need to trade at least 100,000 number of units. Let's say we need to have at least a $1,000 account to be able to trade with a standard lot size. So how we calculate then a potential profit? I will show you a formula so you can do it yourself. You can type this in Excel also, so you will know basically how much money you will gain if you make a pip on a particular currency. Now pay attention to this very closely, because making profits in Forex market, it's not the same for every currency pair. A couple of months ago, that changes slightly. We will see in these examples Euro USD and dollar Swiss franc. Because in Euro USD, we are talking about base currency, that is Euro, and Euro Swiss franc, the base currency is dollar. So there are two different formulas to know how much money you gain if you open a position or lose, of course. So we are talking about standard MetaTrader lot. So let's say today I did this example when Euro USD was at 1.3026. Let's say to 3026. I won't mention the 7 decimal. It's not very valid for this kind of formula. It's not significant, better to say. So how we calculate it? First, we take 0.0001 divided by 1.30267. That is exactly 7.67 when we divide it, of course, by 100,000. And then that number we multiply by 1.30267. So we get rounded up $10 per pip. So this is, I think this is clear. So first, for example, let's say that our Euro USD is standing around 1.30267. Okay. Then what we do? We divide 4 zeros 1, it's 0.0001 divided by 1.30267, and we multiply it by 100,000, and we get this number 7.67. Okay, then 7.67 we multiply by that number 1.30267, and we get this number around here. So this is around $10 per pip. If we use dollar as a base currency, we have another example. We divide the same number, 0.0001, by the current exchange rate. This is 0.9520. So we divide this by this, 0.9520, and multiply by 100,000. So we get 10.05 per pip. So if USD Swiss franc was a little bit higher, for example, let's say Euro US Swiss franc, dollar Swiss franc is above 0.3 or 4, we will get only $6 or $7 per pip. So you can do this a little math, a small math at home, and you will see how exchange rates differ when we talk about making profits or losses. So it's not really hard. It takes a little bit of your time. So you will see how much money you can make by trading standard MetaTrader for lot size. And I think this is very clear to you now. So when we are done with this, we can get on to a next thing called leverage. Guys, do you hear me? Because I don't know if I have a problem, because a guy called Janus told me I'm unable to hear you. Check your microphone. I think now I have sorted. Janardan, I think that your head speakers. Yeah. Okay. Thank you, guys. Thank you. We need to check from time to time. So, if this is clear about making about pip percentage, about pip size, we can go to a leverage. I will give you a definition of leverage. That is maybe the simplest definition you would ever have in Forex market. What leverage is. So basically, leverage is the ability to control a large amount of money in the Forex markets with a much smaller deposit. That is a definition, and really the smallest and really the most clear definition of all. So it's the ability to control a large amount of money in the Forex markets with a much smaller deposit. Be aware that if you want to trade without leverage, if you want to trade a standard lot size, that you would need $100,000 just in order to make one standard lot size, that is $10 per pip. Because most of us don't have that money. There are brokers who help us by giving us a sort of leverage. That is why leverage is called leverage. So let's assume we will be using 100,000 unit, and now I will give you some examples to see how it affects the pip value. So think of your broker as a bank who basically fronts you $100,000 to buy currencies. To trade $100,000 of currency with a margin of just 1%, you will only have to deposit $1,000 into your margin account. The leverage provided on a trade like this is 100 to 1. Now, many traders ask me to simplify the leverage, and I will give you really the most simple explanation. So again, to trade $100,000 of currency with a margin of 1%, you will have to deposit $1,000 into your margin account. So we are talking about standard 100 to 1 leverage. Leverage of this size is significantly larger than the 2-1 leverage commonly provided on equities, or the 15 to 1 leverage provided by futures market. Although 100 to 1 leverage may seem extremely risky, but believe me, it's not risky if you know what to do. The risk is significantly less when you consider that currency prices usually change by less than 1 or 2% during intraday trading. And if currencies fluctuated as much as equities, brokers would not be able to provide as much leverage. And the amount of leverage you use will depend on your broker and what you feel comfortable with. So, typically, the broker will require a trade deposit, also known as account margin or initial margin. Once you have deposited your money, you will be able to trade. The broker will also specify how much it requires per position, standard lot. For example, if the allowed leverage is 100 to 1 or 1% of position required, and you wanted to trade a position worth of 100,000, one MetaTrader standard lot, you only have, let's say, 5,000 in your account. It's okay, no problem, because your broker would set aside your 1,000 as down payment and let you borrow the rest. So you have 5,000 in your account, but you want to trade with standard lot. Of course, you would need to have 100,000. Then, because you don't have 100,000, your broker lends you the money. So your broker would set aside $1,000, that is called the margin, and let you borrow the rest. Of course, any losses or gains will be deducted already to the remaining cash balance in your account. So that is why brokers help us. And that is one of the things I consider on the last webinar when I talk about choosing Forex brokers. Honest broker will always respect your account margin, and you would never have a margin call unless it's specified in the contract. I will talk about margin call a little bit later. So, if the currency underlying one of your trades moves in the opposite direction of what you believe would happen, leverage will greatly amplify the potential loss. And to avoid such a disaster, Forex traders usually implement a strict trading style. We call that stop and limit orders. Stop and limit orders. So What leverage is the ability to control a large amount of money in the Forex markets with a much smaller deposit. I recommend using 100-to-1 leverage. That is a standard leverage in Forex market, and it isn't risky if you know what you should do. So these are, of course, lot sizes we were talking about, and this is leverage. Leverage, again, to give you a brief example, if leverage ratio is 100-to-1, minimum required margin equals 1%. If leverage ratio is 50-to-1, the minimum required margin equals 2%. If leverage ratio is 40-to-1, then it's 2.5. And all down to 10-to-1 when minimum required margin equals 10%. So this is very important when we move to our next question about margin call. This is, believe me guys, very, very important to know what leverage ratio is and minimum required margin. So, margin call. This is a very infamous, how can I say, Forex term. There is also a movie called Margin Call. It's very unpopular, but it happens all the times, especially when Forex traders are over leveraging and when volatility is very, very big. I reckon that a couple of days ago when Euro USD jumped 450 pips, many small accounts were margin called. So what is a margin call? A margin call as a term happens when a trading account no longer has enough money to support the open trades. This happens when there are too many floating losses. Floating losses are losses that haven't been closed. They're floating, they still exist. And the trader hasn't closed his position and he suffers from floating losses. A relative loss is when trader closes a position and he loses money. That is a relative loss. And floating loss is again when open positions are sinking, are in a loss. Let's say a good example of margin call. So this is a good example. Let's say we are using 200-to-1 leverage. Now you listen to me very carefully. We are using, let's say, 200-to-1 leverage. And let's say that we have a $20 account and use $10 to open a trade. So the trade on market would be $2,000, right? Because we are using 200-to-1 leverage. So each pip would be worth around 20 cents. If the market moves against us by 50 pips, that would be a floating loss of $10, right? 20 cents multiplied by 50 pips is $10. Since it takes $10 to keep our trade open, at a floating loss of just 10.01, we would no longer have enough margin to keep our trade open. At that point, our broker will automatically close our trade because we no longer have enough margin to keep that $2,000 trade on the market. This is how a margin call works. Therefore, it is the equity, not the balance, that is used to determine usable margin. Your equity will also determine if and when a margin call is reached. So pay attention to this. I will open it. I will repeat it once more. So we are using 200-to-1 leverage. And let's say we have $20 account and we use $10 to open a trade. So our open size on the market is around $2,000. Each pip is worth 20 cents. If the market moves against us by 50 pips, we would suffer floating loss of $10. And if $10, when go to from 10 to 10.01, we will no longer have enough margin to keep the trade open, so we would suffer a margin call. So we use equity, not the balance, to determine usable margin. That is, I think this is very clear. Usable margin is equal to equity minus used margin. So equity minus used margin gives us a usable margin. If equity is higher than used margin, there is no margin call. If equity is less than used margin, we would suffer a margin call, unfortunately. So, as soon as our equity equals or falls below our used margin, we would receive a margin call. As soon as our equity, again, is above used margin, there is no margin call. So pay attention to this very, very, very carefully when you trade. Don't over leverage your positions, and don't, if you want to be a good trader, always use the stop loss. At least, if you don't put it, at least go with mental stop loss and close the order, because you can suffer from a big drawdown, and after that you can suffer from a margin call. That is one way of protecting. The broker protects itself, because the broker would lose if it lets you to spend that borrowed money. So broker protects itself by using a margin call. So be very careful about that. So next thing directly connected with margin call, average, pips, and all other things I talk today is profit and a loss. So let's make it clear with an example. And this is very good example. In above example, we said that if we open a trade on Euro USD, we would have, let's say, we will trade one standard lot. That is $10 per pip, right? So when we enter the market, we pay for commissions. Commission is paid upon entering a trade depending on lot size. So initially, with Admiral markets, we will pay a commission. We won't pay when we close our trades. We will pay just for entering the market. For each pip, we will get around $10. So let's say it with a good example. Suppose that we have, let's say, 1,500 in our trading account. And let's say we use a leverage of 100 to 1 to trade, of course, with a standard lot size. So suppose that the exchange rate is, let's say today was 1.3065. So we need $1,306 to trade standard lot size. Why? Because 10,000 euros are needed to control 100,000 euros of dollars. And let's suppose that you are a new Forex trader. So you don't know much about Forex trading. However, let's say you have read that it is a great opportunity to make money. So you don't know that stop losses are used to minimize downside risk in trading. And you start trading without putting stop loss. And your trading account grows from, let's say, $1,000 to $1,500. So the margin required to keep the trade open now is $1,306. Each pip is exactly equal to $10 in this case. You will receive a margin call when your equity drops below 1,306, and your open position will be automatically closed at this point. If you subtract from 1500, you subtract 1306 and you will get $194. And that is equal to 19.4 pips of a loss. So this is what you need to take care of. So if Euro USD is at around 30.65, you need $1,306 to trade standard lot. And if equity drops below $1,306, you will be margin called. So if you go with standard lot size on that trading account, you can only allow to suffer from 18 pip loss because you have commission to pay and you have available margin as 19.4 pips. So this is very, you need to be very careful about that. Always put stop loss and try to go one-to-one risk to reward if you trade intraday. Mental stop loss is good for scalping trades with one-to-one risk to reward. But if you go intraday, try to go with 1-to-2 risk to reward. If the market conditions are very bad, then you can always go with 1-to-1. So I recommend trading position size anywhere from 0.3 to 1 standard method trader lot for each $10,000. So this is how I also trade. 0.3 or up to 1 standard method trader lot for each $10,000. Almost exclusively when I see a very good opportunity or a breakout, I can leverage just a bit with 1.5 or maybe 2 MetaTrader lots for each $10,000. But I recommend using anywhere from 0.3 to 1 standard MetaTrader 4 lot. Because you need to know, and after this you will know what margin is, what margin call is, what leverage is, so you won't risk your account. Always remember the first point and the first thing in Forex is to keep the profits, to keep our money running. And the second thing is to make profits. Because if we lose money, we won't have a tool to trade with. So the main thing is in Forex is to keep our money live, running. And that is why I never recommend over-leveraging, and I really never recommend, never ever recommend trading with a margin. I would never trade a standard lot size if I have 100 and let's say $1,500 account. It's too big of a risk, too much of a risk, and with only 20 pips stop loss, we can suffer a margin call. That is why margin calls and profit and loss are very important. And next thing I want to talk about is types of orders in Forex market. There are 5 main types of orders and 5 most used 5 of orders, and those are market order, limit order, stop loss order, and trailing stop orders. So what is a market order? A market order is an order to buy or sell at the best available price. For example, let's say in our previous example, we know that our bid price was 1.3026 and the ask price was 1.3027. So if you wanted to buy euro dollar at the market, it would be sold at 1.3026. If you want to buy, you would buy it at 1.3027. So your trading platform would instantly execute a buy order at the exact price. So that is the market order. So you buy or sell with the best available price. When I trade, I usually use those market orders. I rarely use limit orders, sometimes, but mostly I use market orders. What is a limit order? Limit order is order placed to either buy below the market or sell above the market at a certain price. So let's say again that the euro dollar is at 1.3026. We want to go short if the price reaches, let's say, 1.3050. We can either sit in front of our monitor and wait for it to hit 1.3050. If we do that, we would sell a market order, or we can set a sell limit at 1.3050. Then we can walk away from our computer to attend, let's say, for our other stuff we need to do. So if the price goes up to 1.3050, our trading platform will automatically execute a sell order at the best available price. If we sit and wait, we would enter a market order. So when we use those limit orders, we use this type of entry when we believe that the price will reverse upon hitting the price we specified. So we believe that the price will reverse, and then after that we place that limit order. So mostly limit orders are used when we sleep or when we get away from our trading station. Stop order is order placed to buy above the market or sell below the market at a certain price. Let's say that cable trades at, let's say, 1.5050 and it's going upward. So we believe that the price will continue in that direction if it hits 5060. So we can sit in front of our computer and buy at market when it hits 5060 or set a stop entry order at 5060. If we wait and click at market order, then we will execute the market order. If we set an order at 5060, we would set buy stop order. So we use stop orders when we feel that the price will move in one direction. Stop loss order is again a very important order because it's linked directly to our trade. Stop loss remains in effect until the position is liquidated or we cancel the stop loss order. Let's say that we went long at 30.65. So to limit our maximum loss, we set our stop loss order at 30.40. So that means if we were wrong and euro dollar drops to 30.40, our trading platform will automatically execute a buy order at 30.50 at the best available price and close our position for a 25 pip loss. So that means that our stop loss order has saved us from further losses. Always remember, when we close a buy, that is automatic sell into the market. If we close a sell position, there is an automatic buy into the market. We don't see that on our platform. That is done behind the curtains. But most of the time, that is how Forex market is functioning. So stop losses are very useful if you don't want to sit in front of the monitor all day worried that we will lose all of our money. And we just set a stop loss order in order to prevent further losses so we can go away from our trading station. And the last order we are going to talk today is trailing stop order. Trailing stop is a type of stop loss order attached directly to a trade that moves as price is also moving. So let's say that we are decided to short euro dollar at 30.65 with a trailing stop of 20 pips. That means that originally our stop loss is at 30.85, right? Because we are shorting 30.65, our stop loss is 30.85, and we made a trading stop of 20 pips. If price goes down and hits 30.45, our trailing stop would move down to 30.55. So we are shorting 30.65 with a trading stop of 20 pips. If the price goes down and hits 30.45, our trailing stop would move down to 30.55. Our stop will stay at this price always until it's hit. So with a trailing stop of 20 pips, if euro dollars hit 30.45, our stop would move to 30.55. However, if the price were to suddenly move up to 30.50, our stop would remain at 30.55. So our trade will remain open as long as the price does not move against us by 20 pips. Once the price hits our trailing stop, a stop loss order will be triggered and our position will be closed. So that is concerning those kind of orders. So I think that today we have covered all those basics about Forex trading. Those are really trading basics. So pips, leverage, margin call, lot size, and the types of orders. In next webinar, we will talk about more complex things, about technical analysis, fundamental. But now let's say that you want to demo trade, but you didn't know what market orders is, what stop loss is, what pips is. I hope that I have made it clear to you. So if you have any further question now, you can ask me again. I can explain that. So it's not a problem. We have the time for your questions. I have a question from Nenad Kerkez. Leverage is a general term for any technique to multiply gains and losses. No, Nenad, I told you what leverage is. The leverage is a goodwill of your broker to help you trade. So again, think of your broker as a bank who basically gives you $100,000 to buy currencies. So to trade those standard lots, one standard lot, $1,100 of currency, with the margin of only 1%, you will only have to deposit $1,000 into your margin account. And then we talk about 100-to-1 leverage. So your broker is basically giving you, lending you the money to trade, because you don't have, presumably, you don't have $100,000 to trade with. So that is why your broker jumps in and helps you to trade. Can you please explain stop order and trailing stop? Okay, I will do that, no problem. I joined this session later, so how do I see this whole session again? I think that this webinar is being recorded, so it will be uploaded, I think, tomorrow. So you can see it, you can be able to watch it again tomorrow. I recommend using, is this all Germany time? I'm in Brisbane City. Yes, Germany time. This is GMT +1 time. It's London time. And I presume it's also Germany time. So trading sessions were Germany time. I will turn that slide again. Let's say this is okay. This is it. This is all GMT +1 London time. I presume that this is also a standard German time. So you can see this again. And I will explain again what stop loss order and trailing stop order is. Okay, again, stop loss order is a type of order that is directly linked to your trade. So let's say that you went long at 30.65, and to limit your maximum loss, you set a stop loss order at 30.40. That means that you have 25 pip stop. If your stop is hit, your order would automatically be closed. If you buy at 30.65, your order would be closed at 30.40 with a 25 pip stop, and that is automatic sell into the market to close your order. Every buy order is, every buy or long position is automatically closed with a sell into the market. So when we close that manually, that is done behind the curtains. The platform sell into the market. That is a stop loss. And other kind of order is called a limit, stop entry, stop limit order. So let's say, for example, that cable is trading at 50.50 and it's going upward. And let's say that we believe that the price will continue in the same direction when it hits 50.60. We make a buy stop at 50.60 if we believe that the price will continue to go up after 50.60. So we use a stop limit order when we feel that the price will move in one direction. That is called stop entry order. So we feel that the price will move in one direction. And that is in contrary to pure limit entry orders when we want to buy below the market or sell above the market at a certain price. So there is limit entry. I can explain a limit entry if you want. If you don't want, it's okay. That means that you already know what I'm talking about. So those are kind of orders we use in Forex market. Another question, if you have it, I'll be glad to answer. If you want to know about leverage, if you want to know, we are talking today about trading basics, so keep that questions for those kind of things. Maybe in September we will have a live trading session or after session where I will talk about potential setups on some some pairs for next day or next week. So we will see. Maybe we will have those kind of webinars. So you will trade along with me. But that is maybe that will start in September. But for now, let's stick to those basic trading principles. So those are the things you should know. So here again, trading sessions, pip spread, lots and leverage, lot size, leverage size, and margin call, profit and loss, and types of orders. If you don't have any further question, then we can slowly call it a day and finish with the webinar. And next webinar we will talk about technical and fundamental analysis. How we basically, why we trade and why we call it a setups. I will explain about technical and fundamental analysis, which is very important if you want to know what to do when you open your platform. But prior to this, you should know all about these types of orders. Since this webinar is being recorded, it will be uploaded, I think, in next couple of days. And if you are unclear with something, you can listen to it again. If you don't have any further question, I wish you farewell to our next webinar with me and Chris, or with me alone, and many green pips to you all. So see you in a couple of days, and see you next week when we will learn what technical and fundamental analysis is. Cheers and bye-bye.
The